Every price movement in the crypto market has one hidden driver: trading volume. It's the fuel that powers every bull run, every breakout, and even every crash. In this video, we'll break down what trading volume really means, how to read it, and how it confirms the strength of any price movement. So before we dive into charts and trends, let's start with the basics. What is trading volume? Trading volume is the total number of an asset's units that have been bought and sold during a specific time period, such as 1 minute, 1 hour, or 1 day. In simple terms, it shows how active and liquid the market is. When more people buy and sell, the volume bar grows higher, showing increased participation. But activity alone doesn't tell the full story. To really understand market behavior, we need to look at what high and low volume actually mean. Volume is more than just numbers. It reveals market strength and liquidity. High volume means the market is active, liquid, and full of participants. That makes it easier to execute big trades without affecting the price much. It usually signals strong interest and confidence in that asset. Low volume, on the other hand, shows limited participation, fewer buyers and sellers. That can make the market less liquid, more volatile, and even prone to random price spikes or dumps. Now that we know what volume says about market activity, let's connect it with price movements, because that's where the real insight comes in. The real value of tracking volume is using it to confirm the strength of a price move. Technical analysts typically look at how price changes correlate with volume changes. When the price is rising and volume is increasing, that's a strong bullish sign. It means buyers are stepping in with confidence, and the uptrend is likely to continue, because it's backed by real participation. But when the price is falling while volume rises, it flips the story. That's a strong bearish sign. Heavy selling pressure is driving the move, showing that the downtrend has conviction. On the other hand, if the price rises but volume drops, that's a warning. The trend might look strong on the chart, but underneath, fewer traders are buying. That's a weak bullish signal, and it often means momentum is fading. Finally, when both price and volume are decreasing, it suggests the market is running out of energy. Sellers are losing interest, and the downtrend may soon slow down or reverse. These relationships become even more powerful when the market hits critical points, like breakouts and reversals. When price breaks above resistance or below support, it's called a breakout. But not every breakout is real. The key difference lies in volume. A breakout with high volume shows strong participation. It's backed by conviction and is more likely to continue. A breakout on low volume, however, is often a false signal, a quick move that fades because not enough traders joined in. Similarly, a sudden spike in volume can signal a trend reversal. When buying pressure flips to selling pressure or vice versa, that surge in volume marks the shift in sentiment. And that brings us to the most important takeaway: why every crypto trader should pay attention to volume. Volume is more than just a technical metric. It's the market's voice. It tells you when traders are confident, when they're fearful, and when major moves are forming. By reading volume, you can spot whether a price move is backed by real strength or just temporary hype. Understanding this connection gives you a clearer picture of market momentum and helps you trade with confidence. Now you know how volume drives every price move. In the next video, we'll explore momentum indicators, how traders combine price and volume to predict future moves. If you found this video helpful, drop a like and subscribe to Byte Crypto Academy, where we simplify crypto, one byte at a time.